G'day, Jarrad Mahon here from Investors Edge Real Estate, bringing you my latest Perth property update for June. Really excited to be with you, and I've got a lot to cover today, so stick tight, grab a coffee, put your feet up and take it all in. So let's launch into the market, and this update I've called Prepare Yourself. I'm going to go deep into where things are at in the sale market, the rental market, some of the changes that are going on at a national level, and also go into what you can do to prepare yourself for what's to come. So, going straight into the Perth sale market. Since I came to you 2 months ago, we've had a hell of a lot of changes for the worse in our market. And you can see that our number of properties on the market when I last came to you was about 13,900, high 13,000s, and now we're up to 14,300 around. So we've had month on month increases over the last couple of months. We're sitting now at that level, so things are progressively getting worse with supply. We've got more properties available for buyers to choose, which means that you have to come on and be realistic with your price in order to get sold. We're technically crossing over into more of a buyer's market now, and that means that buyers' attitudes are more like, here's a cheeky offer, take it or leave it. But once we find the price in the market, properties are still selling in that 4-week period, and if they're not, they're going stale, and the chances of getting a result drop off drastically after that. So, number of properties sold, how many are selling per week? You can see that it's sitting, we've actually had a few extra sales going through per week over the last 2 months. So that's a semi-positive sign that we're starting to get a little bit more traction to clear properties off the market, but nothing too much to be excited about. And this is what I really wanted to cover. Nationally, our property markets, take a look. You can picture them, you know, the markets all being like a clock. We have our peak of the market up the top, where Sydney, Newcastle, etc. are at. This is from Heron Todd White, great little way to visualise our markets. Then they start to decline, and then we go into a declining market. And that's where Alice Springs, Darwin, Perth, etc. are at the moment. I was over in the Northern Territory last week, and I can say that their market's very similar to ours, except they've got a lot more trouble in renting their properties than us, and it could be a sign of what is to come. But they're obviously a bit more impacted by the mining sector than we are, so they're going to feel it a bit harder. Then we'd move around to approaching the bottom, and at the bottom, so that's places like Gladstone, Bundaberg, Rockhampton, tipped as being at the bottom. Then they start their recovery, and that's places like Adelaide, Hobart, southwest WA, so not a bad time to look deeper at the southwest of WA. And then they go into a rising market, and so that's places like Brisbane, Ipswich, Cairns, Gold Coast. And I've mentioned and ran a seminar on those areas. Not a bad location to look at if you're wanting more shorter term gains. Perth represents a great sort of time to start preparing for opportunities, and I will go into that a bit more later. So the rental market, where are we at? There's a bit of a map showing all the suburbs we manage in, pretty much the whole of Perth, 128 suburbs, so we have great insights into what is going on. And the number for rent, when I came to you 2 months ago, I was hoping the number of properties for rent was going to stabilise, but it's actually continued up month on month quite drastically now. We were at 6,500 odd, we're now at 7,834 properties for rent. So that's really starting to now flow through to our median rent. We held at 440 there for quite a while. I thought we were stabilised, but there's going to be further falls to come as that median rent shows up the number of properties available. There's a lot to choose from for tenants. So again, the same principles apply in the rental market at the moment. We've had to train all of our leasing managers as if they're a salesperson, give them those skills to get a property rented quickly. And we're still getting properties rented within 2 weeks. Once we find where the rental market is, we need enough quality tenants applying to have choice. We don't want to be sitting above the market and get that desperate tenant that needs a property or has got, you know, not quite 100% background and circumstances. We want to be choosing between quality ones. So once we find the market, we are renting quickly, but we're generally seeing a 10% drop in most areas, and some suburbs are still dropping. So just be prepared for that. Rental vacancy rate, that's showing up in our vacancy rate now. We were holding at 4.1. Over the last 2 months, we've seen it go to 4.4, which is a big jump for last month, and we're now at 4.5. And I expect that that'll, continue to move upwards as unless the number of properties starts to come down. Now, the federal budget, we've all seen it on the news, we've all heard it talked about. Thought I'd just cover off what it means for us as property investors. There's no big changes to taxes on capital gains. Superannuation, no big changes there. Self-managed super funds, no big changes there. There is talks of reforming finance and other things in that space, but nothing as of yet. And there's no big changes to negative gearing or depreciation. They are still, the Greens you can see are bringing, trying to pitch abolishing negative gearing. So that's something that I did write about at the end of last year, and it's now starting to get a bit more traction. Whether or not they'll ever do that, there could be massive impacts to the market, and it could actually backfire on them by seeing many investment properties come off and rents go skyrocket and really change our market like it did when it was last taken out. So watch that space on that one, but no changes as yet. The main part of the budget was incentives for small business, and they're really hoping to create jobs with those. I'm still sceptical as a small business owner as to how much real impact that will have. Certainly better to try and improve that area than not, but the changes cost us many billions as an economy, but they don't really, honestly, to me, mean much. So look, if that does flow on to more jobs, that'll only benefit the property market. So wait and see. And there was also a lot of, looking into, in the budget, there was also a lot of commentary looking into the long-term outlook for the pension, which really remains in question. And they're very much, as a government, starting to push the responsibility back on us to grow our own wealth. And I can see that in 20, 30 years to come, there probably won't be a pension. I know some countries around the world are already starting to move to that. So really, it's better to take action today, start getting your plan together, not wait until it's too late. So, APRA, they're the regulatory body for the banks that insure the banks, and they've made a lot of changes to their regulations lately that are starting to flow through and impact the investment space. So what does that mean? What's happening? Well, there's now a tighter assessment for investors. They're not counting negative gearing in their calculations anymore. So even though negative gearing exists, the banks aren't counting the tax break back towards your income. It has to stand without it. And they're also discounting down the rents in your income column by anywhere from 20%, NAB and CBA are, and Westpac's discounting it down 40%. So that also kind of tells us what the bank's outlook is for the rental market. They're trying to obviously be a bit more conservative and not count on that rent remaining as high and protect themselves in it. So that's a big blow because it reduces our overall serviceability in the bank size. And they're now also not taking, even though you may have an interest-only loan, the interest-only loans in Australia typically run for 5 years interest only and then switch to P&I. And previously, banks would just class your in the expense column for you as the interest-only amount. Now they're counting that and assuming that it's going to go to P&I. There's no guarantees that you'll be able to refinance over to an interest-only loan. So that's also reducing your serviceability assessment, meaning we can borrow less as investors. Now, the swings in what the banks would be prepared to lend before were massive, and they're trying to tighten up the variability of how money's lent out. The generous banks, it's reported that they were prepared to lend as much as 50% more than the tighter banks. So now we're finding a much more even playing field for the banks, and it'll mean that we're not able to borrow as much. So it's not necessarily a bad thing, but it'll just mean we're going to be forced to be a bit more conservative. What'll happen and that impact on the market ultimately could be a bad thing. It'll mean that there's less investors purchasing, less rental properties provided. It'll start to slow our markets. It'll be more difficult for investors to enter into the market, and I can only see that having a negative impact over the shorter term, especially for Perth and Darwin's and those that are already in a declining market. It's not going to help us. So, finally, I'm going to go into some tips to survive and thrive this market. Now, many people might listen to what I've just said and be all doom and gloom about it. I actually see the other side of the coin, see the opportunity that when we go through a cycle, you can come out the other side of it and be set for the next growth phase. Now, that's the exciting thing for me. But you have to be more conservative. You have to get all your ducks in a row and not expose yourself, so that if interest rates do start coming up, you can afford to still hold your property. And if you do get that slight bit of extra vacancy on your property, or your hot water system goes, you've got the money to afford those things. The last thing you want to do is have to sell a property in this market. So, prepare yourself to hold on to your properties over the next 1 to 2 years. The kinds of things that you can do so that you're not ever forced to sell a property is get your cash buffer together. Have at least $5,000 in cash or equity that you can access with the snap of a finger. That's what you need. Free up equity. Now, it's great to ask for money when you don't actually need it. And right now, and over the next 12 to 18 months, there's going to be some amazing opportunities to purchase property at great discounts. When you haven't got lots of other competition, you need to start getting your war chest together to take advantage of those opportunities. So, free up equity in properties where you do have the equity, and set up line of credits, get that money ready for a rainy day or for picking up a great purchase. We're already noticing how much better deals we can get already. So prepare yourself for that. And next point, be open to opportunities. It's so easy to watch the news, get so fearful by it all, and run for cover and do nothing. But if you remain open for the right opportunity, for one that stacks up, that is going to be putting money in your pocket each week. There's no space for nothing that's negatively geared. Definitely do not buy a property if it's negatively geared unless you've got a very clear plan to develop it. And even then, I wouldn't be looking at going into any large developments unless your numbers are fully stacked up, and it's becoming harder and harder to do that. So you really want quick in and out, smaller developments that you can control and not be overexposed in. Of course, if you're weighing up a sale and you really need it done for your personal situation, let's say you want to retire, or say you want to pay down personal debt, just consolidate a bit, then now is the time to sell, not in another 6 months' time. If you are going to sell now. Otherwise, prepare to hold and wait for the next 1 to 2 years. It's certainly going to get worse over the next 6 months before it gets better, is what I'm saying. So think about that if you are looking to offload a property. We're still selling properties, and once we find the right price, you can get your sale. And finally, point 5, probably the most important point, is now's a great time to reassess your plan. And I've got John, who's working closely with us. He's got 20 odd years property and investment experience, and he's able to sit down with you one-on-one and go through your investment plan, and now's a great time to do that. So feel free to just reply to my update and we can book you in for one of those. Finally, wanted to cover off my next upcoming event I'd love to see you at. We're going through the basics of building a new investment property and all the benefits that you can receive from building new with that high depreciation. You'll be positive cash flow from the start, attract quality tenants, and build in some equity as you build. We're running that in cooperation with Ventura, a fantastic builder, and that's at their showroom. We're able to touch, feel, look into how to tailor your build to suit a tenant and also maximise your end sale price as well. So some really great stuff that has gone into that seminar, and we ran it a couple of months ago and we had fantastic feedback, so we're running it again. And I'm also got a special promo for you guys watching. You're able to get free tickets if you use the promo code IEVIP. So go to investorsedge.com.au/build, grab your tickets. That's coming up on the 30th of June, so that's next week, Tuesday the 30th of June, early evening, be a great night, and I'd love to see you along there. Thanks for listening to my update, and do drop me a line on email, just tell me what you're up to, be great to connect with you.